let us quickly summarize all that we covered in this section, Introduction to Company Accounts. We first defined what is a company. What is a company? A company is a voluntary association of persons which is incorporated. It has perpetual succession with its own name and a common seal. A company is also a form of business structure wherein the ownership and management is separate. The owners are many, they are called shareholders and scattered all over. The shareholders appoint a board of directors who are responsible for the management of a company. The provisions of the Companies Act protect the interests of the shareholders. Proper books of accounts have to be maintained in a company. They have to be audited, and the shareholders have right of information. They can speak with the directors and ask questions during the meetings, during their general meetings. Types of companies. We discussed several kinds of companies. We discussed what a statutory company was, a company which is formed under a special act, the audit of which is done by the Controller and Auditor General. We did a government company where 51% or more of the capital is held by the central government or one or more state governments. We discussed a holding company and a subsidiary company. Holding company controls the capital. Either it has 50% or more of the capital of the subsidiary company or controls the composition of the board of directors. Also, a subsidiary of a subsidiary becomes the subsidiary of the holding company. Similarly, we discussed what is a public company and a private company. A public company should have a minimum capital of 5 lakhs, should have a minimum of 7 members and a maximum of n number of members. Their shares can be easily transferred, and its securities are therefore listed on a stock exchange. But in case of a private company, the minimum share capital is 1 lakh. Minimum number of persons could be 2 and a maximum of 50 as per the old Companies Act 1956 and 200 as per the new Companies Act 2013. But the distinctive feature is that there is a restriction on the transfer of shares. It cannot transfer. The shareholders of a private company cannot easily transfer their ownership. We also discussed a foreign company, which is a company which is incorporated outside India with a place of business in India. Similarly, we had a limited liability company, which is what most companies are, and an unlimited liability company where the liability of the shareholders, of the owners, is unlimited, and they would be responsible for the liabilities of the company in the time of winding up. We then looked at the format of the financial statements as per Companies Act 2013. We looked at the format of the balance sheet and the profit and loss account. Balance sheet is prepared in a vertical form with equity and liabilities on the first half and the lower half consisting of assets. Next, we discussed the share capital, where we had authorized capital, registered capital or nominal capital. That is what the company is registered with. With the issued capital being the capital, the nominal value of the shares issued to the public. Subscribed capital being the nominal value of the shares which are subscribed by the public and allotted to them. And then we did called up capital, that is that portion of the capital which has actually been called up by the company, and paid up capital being called up capital less calls in arrears. Along with calls in arrears, we also discussed calls in advance, where money may be paid on a share even before a call is made, in which case calls in advance is not a part of share capital and is shown separately. We also discussed the reserve capital, which is a part of the capital which is not called up, and it is decided by the shareholders that one part of the capital will not be called up and would be called up only at the time of winding up. Such capital would be called a reserve capital. Then we discussed types of shares. Types of shares were basically equity and preference. Equity is a share which is not a preference share, and preference share is a share which has two preferential rights: the right to receive dividend first and the right to take the surplus assets on liquidation first before the equity shareholders. And under preference shares also, we discussed there could be cumulative or non-cumulative preference shares. The shares could be redeemable or non-redeemable. They may be convertible or non-convertible. They may be participating or non-participating. However, usually preference shares are cumulative and non-participating, and they must be redeemable because irredeemable preference shares cannot be issued. Shares must be redeemed, preference shares must be redeemed the maximum of 20 years, within a period of 20 years. With this, we come to the end of the introduction to company accounts. Thank you.